Well, welcome to our High Rock monthly video. Today we have some good news and some perhaps not so good news to pass on, but stay with us. I'm Scott Tomlinson, and with me is my colleague and partner Paul Tepsich, and High Rock's certified financial planning professional Bianca Tomlinson is also with us on the call. Well, as you may all be aware, we operate three investment models from which we are able to apportion an allocation percentage to each client portfolio, depending specifically on your goals, the time horizon required to achieve those goals, and your tolerance for risk and the potential for volatility that may be necessary to take for achieving those goals. And we build all of these out in your wealth forecast. In our conversations with our clients, we try to stress that there is a longer term outlook for everybody's time horizons. And although we do have to report portfolio performance each quarter of the year, we remind you that it is simply a snapshot in time when we look at that quarter or even a year's performance. And as most of us have longer than 10-year time horizons ahead of us and our goals to match them, it is more important that we focus on those longer term goals rather than the short term swings in portfolio value. As an illustration, have a look at my portfolio performance. It is basically the same framework, a 60% equity, 40% fixed income model with all the same holdings as all of our clients, although my asset allocation model has a 15% exposure to the tactical model, a 45% exposure to the global equity model, and 40% exposure to the fixed income model. Now, here's the good news. My portfolio is actually better now than it was at the end of October. And like most of our client portfolios, it's a similar experience. So despite the worst December in stock market since 1931, which was relayed to all of us via our year-end quarterly report, we can also see that the best stock market return since January 1987 has, in the short term, brought my portfolio and most of our client portfolios back considerably. The point being is that most of this is just short-term noise in the markets, and as we've seen historically over longer periods of time, the noise becomes nothing more than a whisper or perhaps a brief footnote. Now, what is important, of course, is staying focused on the long run. Paul, anything to add?
No, but I don't know if it's appropriate right now, but I did read something today from a guy I respect who said, we don't have the ability to figure out where the markets are going to go. No one really truly knows that. Warren Buffett, nobody really knows that. But what we do have an ability to know, given our experience and research, is where we are today. And maybe we'll get into a bit more of that as we move forward. But as you said, the past few months have been extremely volatile. But at the end of the day, we stay the course.
Exactly.
And the result, the performance that you've seen in your portfolio and all of our client portfolios is a result of that.
And here's a good example. We've got 5 months worth of global equity markets here. You can see up at the top the total return over 5 months, and the global equity market is down about 5%. But a good chunk of that all occurred, or a great chunk occurred in December. And of course, we've seen improvements in global equity markets through the course of January, and something that will continue to happen as time goes through, right? Volatility will happen. And as I said, if you took a snapshot at any particular point in time, your portfolio is going to show whatever it is that has happened most recently. But again, we have to continue to take a longer term perspective on all of this. Same with Canadian stock market. December was a very difficult month. January has been a significantly better month. And in fact, over the last 5 months, the Canadian stock market has outperformed the global equity market, although all those two markets are still negative. The Canadian stock market has actually outperformed to the even if it's negative. And of course, key component of our portfolios, as most of us have somewhere in the vicinity of 40 to 50% fixed income in our portfolios. Portfolio fixed income, the bond market had a very rough September, but subsequent to that, October, November, December, all were counter to what stock markets were doing. So again, that's the balance that we've come to expect from bonds and possibly the hedge. Paul, any comments on these?
Nothing really to add there, Scott. Obviously, the bond market, as you can see, is green in the top part of the chart. So it did help add value, certainly through the month of January, as the equity markets did as well, to a much greater degree. But the bottom line there is, maybe people would ask why bonds have added value over the month of January. And the bottom line is, certainly the U.S. Central Bank, the Federal Reserve Board, the chairman has come out and over basically a 5-week period from December till January stated that he is much more what's called dovish, or not being as hawkish about raising interest rates. So, and even today, government bond yields continue to decline. And we've had that view for a while, and we certainly pay attention to the government bond market as an indication of or a leadership for other asset classes, including equities. So the bond market is clearly telling us something here, and I think the chairman of the Federal Reserve Board recognizes that the economy in the U.S. and globally, most certainly China and throughout Europe, and Europe is the biggest economy of all, is slowing down. So we're seeing what we saw in 2016, 2017 being global growth. Now we're seeing global slowdown, and that's why the bond market is showing positive performance over that 5-month period. Because as economies slow, central bankers typically think about cutting rates, and the government bond market and yields are starting to get ahead of that, and yields drop and price goes up. So that's what we're seeing. Good, Scott.
And again, we know that our focus is long term, and we are always trying to get better than benchmark returns per the unit of risk that we take. At times, we're going to be more comfortable taking less risk because we are uncomfortable with levels of volatility. And certainly, we've talked a lot about where we are in the late stage of the economic expansion cycle, and what we've seen is just further developments of that, increased volatility. And as you said, central banks are starting to take note of the fact that we're there. But we do believe to a large degree that despite the fact that central banks are taking notice, it's already too late. We are already seeing this slowdown, and the slowdown will likely pick up some momentum, which will force the central banks to act at some time down the road to lower interest rates. But the global slowing of economic growth has already begun, and it may well be that central banks will have to act sooner rather than later. And this is what happens at the end of a cycle. So if we look back at what happened in 2007, 2008, volatility picked up as we moved into the end of that economic period. It's the same as what has been happening here. But it is really only the beginning of the end of the economic cycle that we're seeing. So there is great potential for more volatility as we move forward. And as it stands, we're putting about a 60 to 70% chance of seeing another test of the market lows, which could take us back to this bull trend line that began way back in 2009. We almost got there in December. We actually have orders on or about, buy orders on or about that trend line to spend some of the cash that we've been sitting on. It didn't get quite that far in December, so we didn't have opportunity to add equity positions to our client portfolios through the month of January. But we do expect to see that there will be another leg lower. We put, as I said, a 60 to 70% chance on it coming back to test this trend line in in somewhere in 2019. And then from there, another potentially 30 to 40% of it breaking down below that trend line when buying support just evaporates. And again, we'll reserve some cash to take advantage of that situation if that does occur. So that's kind of the not so good news. We're only partly into the end of the cycle, and there's a lot more to come, and that we believe warrants continued caution from our perspectives. Paul, do you care to add?
Yeah, and again, going back to that quote I was talking about earlier, we don't know for sure the market's going to sell off, and we don't know for sure it's going to go up. We don't know where the market's going to go. What we do know is where we are today in the economic cycle. We have a good handle on that, and that's how we're managing our risk, which, as you noted, Scott, is a fair amount of caution right now. When we rather, as we wrote in our year-end, I think we probably wrote in third quarter, September 2018, but certainly in our year-end, we're willing to forego a little bit of the upside because we think it's fraught with risk. So we can preserve and protect our capital because we do feel like at the end of the economic cycle like this, we are going to see further downside. And if we're wrong here, I'd be shocked, number one, but number two, we still have risk on our page, but we have less volatile risk than pure equity risk. So our clients need to know that. We take what we think are positions and risk that are able to produce stronger risk-adjusted returns over time than pure equity risk. So I think we have some smart risk on our page right now.
Absolutely. Thanks, Paul. All right, well, that's it for our monthly video. If you do have any questions about this, what we talked about today, or any other specific aspects of your personal portfolio or your wealth forecast, we are always available. Please feel free to get in touch with us at any time, as Paul would say, 24/7. And on another note, Paul will be in Vancouver in March. If any of our Vancouver clients who are listening wish to meet with him, please let us know, and we'll try and set something up. For Paul and Bianca, I want to wish you all a good month of February. Hopefully we get through it quickly and we get closer to spring, and we'll be back in early March with another monthly update.